SwayamPrabha. Digital India. Educated India.
Welcome to session number 19. Here we will be discussing about interest rate swaps. In the earlier session, we have discussed about various tools of hedging, currency hedging, and we have discussed for your forward market, forward contract. We have also discussed future. We have also discussed currency options. Here we will be discussing about interest rate swaps. How interest rate swap can be useful for minimizing the what is called the currency risk, also as a strategy for the hedging purpose. Here you are hedging the interest rate, because corporates are borrowings from different markets. The borrowing may be fixed rate, borrowing may be variable rate, that is the rate floating rate, and fixed rate and floating rate borrowings are also depends upon the rates depends upon the rating of the company. So, a company is maybe having high rating, he can borrow as a fixed or variable rate low interest rate, but company rating is not good, need to pay very high interest rate. At the same time, it is we have seen in actual market scenario, some companies are highly rated in one country, some companies are not good, not so good rating in other country. So, rating decide the interest rate. If you some company which are good highly rated, they can borrow from that market a lower interest rate and exchange the interest rate payment or swap the interest rate actually those who are not in a position to borrow from that market. So, that is called swapping of interest rate. Possibilities are there, and these swaps provide some kind of hedging instrument to reduce the corporate burden in paying interest rate. We will be discussing here how you can use the interest rate swaps for minimization of interest rate risks and also improving the value of the corporate balance sheet. So, interest rate swap is very as old as the financial market itself. However, the interest rate swap, though it was quite useful, it was in practice prior to 90s or early part of 20th century, but nowadays corporates are using the interest rate swap very frequently to minimize the interest burden on their balance sheet. The question is, what is interest rate swap, what is the mechanism of the interest rate swap work, who are the player, how the player operate among themselves, and also how actually the practical in actual practice the interest rate swap works. We will be discussing the same in the current session. So, what is actually swap? Swap, if you see literally meaning, is a exchange. Literally meaning means when English literature dictionary tells us swap means exchange. What you are exchanging? Some underlying asset, but underlying assets you are not exchanging, the value on the underlying assets you are exchanging. So, swap is a financial transaction in two financial transaction among whom? Among two parties, two counterparty to agree to exchange a stream of cash flow or a payment over time. Swap, as I mentioned, is a financial transaction in where two parties agree to exchange the cash flow or payment over a period of time. Swap is an agreement between two parties to exchange a sequence of cash flow for a set of time period. All swaps involve exchange of series of periodic payments and usually through a intermediary. The two party they may not know each other, a intermediary may come in place, a intermediary introduce this two party and two party exchange the stream of cash flow which is profitable to them, both of them through the intermediary. Generally the intermediary is a financial institution and intermediary keep the record or called swap book for the two party, and in between by doing this the intermediary get a commission from the two party. The two party come to each other through intermediary, they exchange the series of periodic payment, the payment against the underlying asset, and the intermediary maintain the books of record, the swap book, and by arranging the swap or exchange of periodic payment the intermediary get a commission out of that. The swap market, swaps are customized product because the swaps are rarely traded, is a customized product as per the requirement of the two party, the swaps design, the periodic payment design, and since it is a intermediary, it is a what is called customized product and it is a OTC product, the credit risk is very high. It may happen that one party may not adhere to the swap position or swap exchange. After some time the market is so volatile, may not be in a position to adhere to the swap contract. So, since it is a OTC product, liquidity is not there, it is a OTC product, there is a credit risk. So, however, in some countries swaps the intermediary provide the guarantee. So, rarely happens this, swap intermediary only acts as a intermediation between two party for maintaining the swap book. Intermediary rarely provide any kind of guarantee for the swap payments. So, for that reason in case of swap the credit risk is very high. So, however, despite the disadvantage, swaps are being practiced as a financial instrument for transaction of exchange of swap payment, exchange of periodic payment. Generally it is used in case of interest rate and currencies market. In this session we will be discussing about swap related interest rate payments. However, in the next section we will be discussing about swap related currency transaction. Now, let us come to the interest rate swap. Interest rate swap I mentioned it is a plain vanilla, it is a open, it is a very plain, there is no such kind of complexity associated with this, it is a very plain vanilla type of product. Here interest rates are the periodic payments and there will be a notional principal. Against this principal the interest rates are related. Two party agreed to swap the interest payment, notional principal will be the base calculation, and the party, suppose the two parties are A and B. Suppose party A agreed to pay party B a predetermined fixed exchange rate against on a notional principal, party B will pay a variable interest rate on the notional principal. So, the fixed and variable interest rate exchange, periodic exchange will take place, and party B, the party having a variable interest rate, that risk will minimize and the risk will be taken over by the party A. So, in this position the fixed and variable interest rate swaps take place and on the basis of agreement the swap transaction take place. There is an intermediary between these two party, the intermediary maintain the record of swap transaction. So, since it is a customized product, the customization take place on the payment of interest rate, whether it is annually or quarterly or monthly or any particular interval, there will be swap transaction or swap exchange of interest payment take place. So, it is a very plain vanilla type of product, but you have to understand this product, there are some terminology associated with this. What are the features of the interest rate swap? There is a notional principal, is a $1 million, $2 million or $1,000, there is a notional. On this notional there is notional the interest rate calculation take place. There is no transaction of notional principal. Notional principal only help in calculating the interest or series of payment. That is a trade date, the date on which swap contract signed, that is a trade date. Two party come to through the intermediary through the intermediary they sign the contract for payment for exchange of series of payment, that is called trade date. Effective date, the date on which the interest rate swap operationalized. It may operationalize, the trade date is today, operationalize take place after 3 months. The 3 months, after 3 months the effective date start. Effective date is essential because on that date the interest payment or the exchange of swap transaction take place. So, 3 different terminology: notional principal, trade date and effective date. Then to understand the swap, you have to go through the example, because as I mentioned here, the underlying is asset, that is a notional principal, and on that principal the interest rate calculation take place, and interest rate payments are the exchange or swap exchange take place. So, to understand the swap exchange, let us do a problem. The problem is here: on July 31st, 2012, company A and B enter into a 5-year swap with the following term. Company A pay company B a amount equal to 8%, that is a fixed interest rate per annum on a notional principal of 2,50,000. Company A pay company B an amount equal to 8% of fixed interest rate. The fixed interest is 8%, company A pay to company B, and notional principal is here 2,50,000. Company B pay a company A an amount equal to 1 year LIBOR plus 2% per annum on a notional principal of 2,50,000. Here company A pay company B a fixed amount 8%, company B pay company A amount 1 year LIBOR plus 2%, and the notional principal is here 2,50,000. You decide what is the payoff for the both party. So, here let us do the problem. What is the transaction here? You have to understand, because while doing the swap transaction, you have to do the diagrammatic flow of swap transaction. Here company A and company B are there, two company, interest rates are 8% fixed, another is variable interest rate, that is a 1 year LIBOR plus 2%, a notional principal is here 2,50,000. So, there is no other variables available here. So, first to draw the transaction diagram. Transaction diagram is here company A and company B. We have two company A and company B, company A and company B here. So, company A exchange, company B A provide fixed interest rate, fixed rate to A, to B, fixed rate is 8%, and company B gives to A variable interest rate or floating interest rate LIBOR plus 2%. The transaction take place, company A give 8% to company B fixed interest rate, company B provide LIBOR floating interest rate, that is LIBOR plus 2%. This is transaction. What does it mean? It means that company A is in a floating interest rate of company A, company B provide, company A provide 8% to company B provide floating LIBOR plus 2% to company A. So, what does it mean? Here transaction take place from A to B, one is a fixed interest rate, another is a variable interest or floating interest rate. Here notional principal is 2,50,000 US dollar. 2,50,000 US dollar. So, who is in variable interest rate, who is fixed interest rate? Here company A provide the fixed interest rate to B and company B provide the floating interest rate to company A. So, company B or there is a transaction of floating and fixed. One wanted to convert its floating interest rate to fixed interest rate and another company, the other company wanted to take the risks of floating interest rate. So, there is a interest rate swap here. The swapping of what is called floating to fixed, it is the interest rate swaps here. So, there is a agreement between two parties A and B, one party is in floating interest rate, there is a risk for him, another party is a variable interest rate, fixed interest rate, he wanted to take the risk. So, the other party surrender the variable interest rate to the party A and party A provide the fixed interest rate to party B. So, there is exchange of interest rate swap, what is called fixed to floating, and in this process one company accept the risk, another company surrender the risk. Now, how to do the calculation process? The calculation process is here. If you see the calculation on the 31st July, so here company A paid to company B how much? 8%. The company on 31st July, suppose the date is ending date is July 31st. Company A pay to company B what? Fixed interest rate of 8%. On what notional principal? Notional principal is $2,50,000, on that 8% that is $20,000 pay to company A, pay to company B. Our transaction here, if you see our transaction, company A surrender 8% to company B. So, our transaction here, company A pay to company B 8% of notional principal 2,50,000. So, that is 20,000. And suppose we assume that on 31st July the 1 year LIBOR is something around 6.1%. So, assumptions are there. Assumptions, because we do not know, LIBOR may change. 1 year LIBOR is floating. So, 1 year LIBOR assumption is there on 31st July, the LIBOR is 6.1% and plus 2% is added here, that is 8.10% is on 31st July. So, 31st July what will happen to company B? Company B will pay to company A how much? LIBOR plus 2%, LIBOR is 6.10% on 31st July, the assumption is there, and 2% extra, so 8.10%. So, 8.10% to pay. How much is paying? He is paying on 2,50,000, 8.10%, that is $20,250. So, there will be transaction take place. Now, if you see the diagram what we have done, company B will surrender floating interest rate LIBOR plus 2% to company A. So, now we have done same thing, company B surrender LIBOR is 6.10 plus 2%, 8.10% of notional principal 2,50,000, 20,250. So, what is the stream of transaction take place? Company B 20,000, company B will pay 20,250 to company A, company A will pay 8% of 2,50,000, that is 20,000 to company B. So, actually payment will take place only company, because company B is supposed to pay more. So, the company B will only pay $250 to company A, because here the net transaction will swap, net amount who is supposed to pay more, company B is supposed to pay more to company A. So, net transaction is net amount, net surplus is only for company A. So, company B will pay $250 to company A, net surplus transfer will be there, net transfer surplus transfer is $250 to company A, the company is paying A. Suppose LIBOR become after, suppose now this is transaction take place yearly basis. Now, after 1 year, LIBOR in place of 6.1% becomes 5.75%. What will happen? The transaction will change now. The transaction will be after 1 year. Now, we are going to July 31st, 2012, after 1 year. So, company A will pay how much? Company A will pay and company B will pay, again swap transaction will take place. Company A will pay, company A pay to company B how much? Now, same notional principal remain the constant, in same 8% fixed will pay. So, dollar will be 20,000 again, but now the LIBOR is 5.75% plus 2%, now it is 7.75%. So, what company B will pay now? Company B pay to company B pay to company A how much? Now, LIBOR plus 2%, LIBOR is 5.75, 2% extra, company B will pay to A 7.75%, the transaction will be $2,50,000 or 7.75%, that is the amount company B pay to company A. Company B, this amount definitely less, because it is less than 8%. So, company B will pay less amount. So, here company B paid to company A only 7.75%, it is a less amount. Now, company A net transaction will be company A will pay to company B. If you calculate this is definitely less than that, company A will pay to company B. So, since LIBOR is fluctuating, the fluctuation of net cash flow will be there. Since we are exchanging a fixed interest rate against a floating interest rate, the interest rate swap designed on that basis. Since LIBOR is fluctuating, net surplus also fluctuate, and who will be paying what depends upon the 8% which is fixed. The payment date, due date of payment, LIBOR plus 2% is less than 8%, then company A will pay to company B. If LIBOR plus 2% is more than the 8%, company B will pay to company A. That is the transaction process take place till the swap is end. Swap maturity date is here, as I mentioned, we discussed about the problem. Swap maturity date is 5 years. The every end of the 1 year, the transaction will continue till the 5 year end. That is 5 year contract between A and B company. So, this is the process of transaction of fixed to variable and variable to fixed. The variable interest rate become fixed now, and the party who is accepting the variable interest rate is bearing the risk, and depends upon the risk for him, risk is for him is a variable interest rate, and he will be in a position to get profit so long as the LIBOR plus 2% is more than 8%. If LIBOR plus 2% is less than 8%, he will be loser. Now, let us do another problem. And what is the advantage? Before doing another problem, let us discuss about the advantages of swap. Advantages of swap is many are there, primarily the rating side and the interest rate floating and fixed exchange rate, fixed side. When company is good rated company borrow as a lower rate than the bad rated company, and there will be swap between the two company. Bad good company will borrow and give it to the company which is not good. For them they will borrow and there will be they get the profit out of that. Similarly, some companies are highly rated in one country, so they will borrow as a lower interest rate and they will transact to another company. And third is that some companies are in a position to bear the risk, so they absorb the floating interest rate and there will be transaction of interest rate swap between fixed and floating interest rate. That the advantages are there in swap transaction. As I mentioned earlier, swaps, all swaps are customized product and customized product through OTC market, that is over the counter market. So, there is no such kind of exchange traded funds are available here. So, since they are OTC, the credit risk is very high, the counterparty risk is very high. So, that is a disadvantage also there in case of swap transaction. To understand further about the swap, interest rate swap, let us do another problem here. Here the problem is linked to floating to both are floating and both are fixed. And here we will understand that even though two party can borrow two different markets or the same market either in floating or in fixed, but there will be position that one party is getting very high rate, another party is getting very low rate because of rating. How rating differentiate the interest rate and how it is help in interest rate swap transaction process. Let us do the problem. The problem is here there are two company A and B. Company A is rated AAA, company B is rated BB. Company A is good company, company B is a bad company. So, company B is getting good rating of AA, company B is a bad company, he is getting a rate, he is getting a high low rating. So, for him it is difficult to borrow at the very high rate. So, they wanted to go for a transaction, of interest rate swap. So, what is the problem? There are two company A and B, company A is a AAA company, company B is a BBB company. Because of best rating, company A is able to get funds from the market quite lower rate than company B, both in terms of floating and fixed. The fixed rate company A is getting as a fixed rate 6% and floating rate LIBOR plus 25 basis point. Company B is not a good rated company, so he is getting as a higher fixed rate, that is 6.75 and higher floating rate LIBOR plus 50 basis point. So, is there any possibility of swap transaction between the two company? That is our problem. So, what you understand here? A good company get a fund as a both in fixed market and floating market lowest possible rate. A bad company get both in fixed market and floating market higher possible rate. So, there may be transaction of interest rate swap between the two company. So, what is the process here? Same way. So, what we will do here? Now, suppose there we will see which rate they should transaction take place, whether fixed or floating rate. If you see the problem, the company is getting at the fixed rate 6%, floating rate LIBOR plus 25 basis point. Company B is getting 6.75 and LIBOR plus 50 basis point. So, the differential interest rate in case of fixed between company A and company B, the fixed interest rate between company A is getting 6% and company B is getting 6.75. So, the differential interest rate is 0.75%. That means, company A is getting lower amount, low interest rate, company B is getting higher interest rate. So, its possibilities are there, company A can borrow for company B and give the money to company B. So, there will be a transaction take place between company A will get at 6% rate and borrow from the market and give it to company B and get a commission income for that. That is, transaction may take place between two companies. But if you see the LIBOR side, floating interest rate side, the company A is getting LIBOR plus 25 basis point and company B is getting LIBOR plus 50 basis point. the differential interest rate between company A and company B for the floating interest rate side is 25 basis point. So, what will be transaction take place? This table indicates the company A is better rated than both in fixed and floating. Its possibilities are there, company A has a more advantage in fixed rate than the floating interest rate. The company A is more advantage in floating interest fixed interest rate than company against the company B for floating interest rate, because company A is getting a differential interest rate between two company in fixed interest rate side is 0.75, but in case of floating interest rate side is 25 basis point. So, company A supposed to borrow from the fixed market and transact to company B. So, what is the rate take place? That two different position interest rate swap can be designed here. One is fixed to fixed, the higher fixed to lower fixed. Another is fixed to floating, that is company A will borrow at 6% fixed and company B will borrow LIBOR plus 50 basis point, that will fixed to floating interest rate swap can also possibilities are there. Now, let us do for one by one. So, first is here company A, that is company A, that is a floating to fixed now will take place. What will do the answer here? Company A will borrow at 6% fixed, company B will borrow at variable plus 50 basis point, and there will be transaction take place between these two. So, what company A? Company A will borrow at 6% and company B will borrow at LIBOR plus 50 basis point, and exchange of interest payment take place between the two party against a notional principal. On the settlement date, that is a due date, that is a due date of payment, the company effective date of swap, company B on the basis of LIBOR market, company B will surrender 6% to company A, and company A will surrender LIBOR plus 50 basis point to company B, and this process the transaction may take place. Suppose what is the transaction site here? If you see company A and company B, so what will take place here? Company A will give borrow from the market at 6% and company B will borrow from the market LIBOR plus 50 basis point. So, company A will surrender to company B a what is called LIBOR plus 50 BPS, and company B will give to company A 6%. In this process, company B is making its interest rate fixed and company A is accepting the floating interest rate of LIBOR plus 50 basis point. So, LIBOR suppose after 1 year, suppose the swap transaction effective date is 1 year only, but every year the swap transaction take place. So, suppose in 2012 this year the effective date suppose July 2012, company A pay company B, company A pay company B LIBOR plus 50 basis point and company B pay company A %. This is the transaction take place floating to fixed, company A converting its, company B is converting its floating to fixed, company A is accepting the floating. So, now suppose in July 2012 LIBOR 1 year LIBOR is suppose around 5.5%. So, this LIBOR will be how much? 50 basis point. Now, it is become, suppose it is 6.5% in place of 5, 6.50%. So, this will be 7% and this will continue 6%. So, what will happen? The transaction take place what? Company A pay company B 7% on notional principal, company B pay company A 6%. So, there will be company a net transaction will be net payment will be 1%. Who will pay 1% extra? Company A will pay to company B. A will pay to company B. Suppose in 2013 July, again the interest rate become LIBOR will become 5%. So, now 5 plus 50 basis 5.5, the company A will pay to company B LIBOR plus 50 basis point 5.5, company B will pay to company A 6%, here company A is receiving side. So, net transaction will 50 basis point and company B will pay to company A LIBOR plus 50 basis point is 5.50. The swap transaction take place and one party accepting the fixed, another party observing the floating. So, this is called this interest rate swap floating to fixed, but this question is here only floating to fixed possibilities are there is other way also possibilities are there. Here another possibilities are there. If you see the diagram, I have given the diagram earlier also, same diagrammatic transaction, company A surrender fixed in give the fixed 6% to company B, a company B floating interest rate 50% will company A. So, that is different, but now suppose there are other way possibilities are there for this question. Here if you see, here only one way we have done it, that is a fixed to floating. Now, it is possibilities are there, company B will borrow at 6.75 and company A will borrow at LIBOR plus 25 basis point. The possibilities are there here also. Now, what will happen transaction take place? Company in LIBOR is fluctuating here, there will be possibilities are there, some profitable transaction may take place. So, company A will borrow from the market LIBOR 25 basis point and company B will borrow at 6.75%. So, there will be transaction there will be transaction may take place also here, but depends upon LIBOR. LIBOR is highly volatile, cross more than less market, then possibilities are there will be transaction may take place, but this transaction its viability depends upon the fluctuation of LIBOR. However, the best transaction is here converting company A will borrow at 6%, company B will borrow at LIBOR plus 50 basis point. So, there will be transaction is profitable for both the party, but second transaction may be profitable depends upon the LIBOR fluctuation side. Let us do another problem. Here in January 2010, company A and company B enter into 10 years interest rate swap with following term, 10 years interest rate swap with following term. Company A pay to company B an amount 11% fixed per annum on notional principal of 2 lakhs and company B pay company A an amount equal to 1 year LIBOR plus 4% per annum on a notional principal of 2 lakhs. Decide the payoff. So, the company A is borrowing at fixed interest rate, company B is borrowing at variable interest rate, and it may happen that there will be a transaction between variable and fixed interest rate. Company A may be, because it is borrowing at very high interest rate or 11%, they wanted to accept a floating interest rate. Company B is not comfortable in floating interest rate, they may be suitable for a fixed interest rate. So, there will be transaction take place between the two party in the form of conversion of fixed to floating. So, the transaction will be how, what is the transaction process? The company A by borrowing 11% give it to company B and company B borrowing at LIBOR plus 4% give it to A. So, company A 11% will pay by the company B, and company B floating plus LIBOR will be paid by the company A. That is, transaction will take place like that. So, what is the transaction here? The same thing. The company A fixed 11%, company B floating LIBOR plus 4% floating. So, company B will borrow from the market LIBOR plus 4%, and this LIBOR plus 4% transferred to company A. So, company transferred to company A. Company A will borrow fixed interest 11%, the 11% amount will transfer to company B. So, now transaction will take place and notional principal is here. Notional principal is 2 lakhs US dollar. 2 lakh US dollar. Now, company A that 11% into US dollar 2 lakhs, US dollar 2 lakhs, and company B LIBOR plus 4% into US dollar 2 lakhs. So, now company B will pay company B interest rate, that is LIBOR plus 4% will pay by the company A. Company A 11% interest rate will pay by the company B. Now, the transaction take place, suppose after 1 year, suppose every year transaction take place, LIBOR after 1 year LIBOR become 1 year LIBOR becomes 7%, 8%. So, what is the floating interest rate? LIBOR plus 4% for company B. Company B is borrowing. So, now LIBOR plus 4%, 8% becomes 4% is 8% plus 4%, here it is 12%. So, company B is borrowing at 12%, company A is borrowing at 11%, 12% company A B transferred to the company A, 11% of borrowing company A transferred to company B. So, in this process 1% payment extra which is supposed to be paid by the company A to company B. The transaction will take place like that. Here what is the problems here? What are the advantages of both party? One party is borrowing at very high fixed interest rate, it is not comfortable. Now, he is thinking that interest rate may come down. So, he is wanted to convert the fixed high interest rate to floating interest rate. One party B, other party B is here, he is not comfortable LIBOR plus 4%. Every year LIBOR is fluctuating, there is a risk for him. So, he wanted to transfer the risk to other party. In this process, the two party come to a intermediary, a financial institution. A financial institution, the financial institution act as a intermediary between the two party, and there will be transaction, a flow of interest, a stream of interest flow will be there, and in this process they sign a agreement for converting the fixed to floating and floating to fixed, and in this process interest rate swap take place. If you see the answer here, what is the position? You see the answer here, company A on January, suppose 1st January 2011, company A will borrow at 2 lakh 11%, company A will pay to company B fixed interest rate, transfer the fixed interest rate 2 lakh 11% 22,000 US dollar. Let us assume that on January 2011, January 1st 2011, 1 year LIBOR is 6.5. So, here 6.5 plus 4%, that is the 10.5, 10.5 of 2 lakh this is 21,000. Who will pay 21,000? Company B will pay to A 21,000. So, company A is paying to B 22,000, company B is paying to A 21,000, actual transaction will take place 1,000, and in this process company A who is surrendering, who is borrowing at 10.5%, and company B is company A is borrowing at 11%, company B is borrowing at 10.5%, and there is a transaction among here two party, a company A will be profitable, because company A is accepting now the variable interest rate of 10.5. So, company A is profitable now. So, like that the transaction may take place between these two, and the transaction is profitable or loss to a particular company, that depends upon the variability of LIBOR, 1 year LIBOR. Now, in this process let us we have discussed about the interest rate swap. Interest rate swap, as I mentioned here to you, that interest rate swap is profitable to both party, because the profitability of depends upon the how they predict the interest rate. Generally the floating into fixed and fixed to floating interest rate conversion take place through interest rate swap. It may happen also higher floating and lower floating interest rate can also be take place. The interest rate swap can also be designed. The interest rate swap, generally the company they do not know each other, they may be having in different country, they generally come through a intermediary. Financial institution generally act as intermediary in interest rate swap transaction process. They maintain the swap book, and in this process they get the commission income from the both party. Interest rate swap nowadays is quite useful for the company, because company generally borrowing at higher interest rate because of their bad rating. They wanted to convert into a lower interest rate through a good rating company. In this process interest rate swap design. Similarly, company may not, a domestic company may not be aware of the other market where interest rate is available as a lower interest rate funds are available. They swap the position through other company. In this process they can design the interest rate swap also. Interest rate swap is quite useful for maintaining the books of account or the balance sheet position, because in this process the two party get the profit out of the interest rate swap. So, they reduce the interest burden, and this help in providing reducing the interest burden of the company. However, interest rate swap, as I mentioned to you, is a OTC product, it is high risk, since OTC product counterparty guarantees are not there. So, counterparty may default. In this process counterparty default create some kind of default risk for the company. So, however, since some country the intermediary provides some kind of guarantee in the counterparty guarantee for the interest rate swap, but that is very few companies, good financial institutions are there, they generally provide counterparty guarantee, but it is rarely available in actual market. Let us discuss some references are here. Interest rate financial management side, if you see the Sen Yun and Resnick book you can follow for interest rate swap side. Multinational financial management, Jeff and Madura, you can see the interest rate swap side here also. And multinational financial management by Allen and Shapiro, the Willie Eddy's here also you can see the interest rate swap calculation process. The model question here, the model questions here explain with example and diagram the concept of interest rate swap. Here you have to design what is the meaning of interest rate swap, and through two companies or two corporation you can design the diagram how the interest rate swap can take place among these two companies, how the company can transfer the fixed to floating, convert the fixed interest to floating interest rate, or fixed floating interest to fixed interest rate, or two floating interest rate they can transact interest rate swap can be designed. You also mentioned there what are the advantages are there in swap transaction. You also mentioned there what are the features of swap transaction. You also mentioned there the difficulty or the disadvantage of swap transaction. The rule of the intermediary you also mentioned there interest rate swap transaction process. Then you can give some kind of example how the interest rate swap transaction take place when there is a floating interest rate, when a fixed interest rate, when there is a very high floating interest rate and very low floating interest rate. Also you can see, you can also mention how we can design a interest rate swap when there is two companies are both are in floating interest rate. There also it depends upon the which interest rate base they are in LIBOR base or any other base. So, base also fluctuation will be very high. So, you have to see the which base they are there. So, in this process two floating interest rate loan or interest rate can be exchanged also. Second problem is here there is a two companies are there. Here January 1st 2012, a company A, company B enter into a 10-year interest rate swap with following term. Company A pay company B an amount equal to 9% fixed per annum on a notional principal of 10 lakh rupees. Company B and B pay company A amount equal to 1 year LIBOR plus 3.5% per annum on a notional principal of 10 lakh. This is the payoff here. The payoff here, what is the diagrammatic designing of the interest rate swap? Here two companies are there, one company is in a fixed interest rate, another company is a variable interest rate. The variable is linked to LIBOR fluctuation and there is a notional principal here 10 lakh rupees. 10 lakh rupees notional principal is there. So, you have to, there is a stream interest rate flow will be there. The company A is not, company B may not be in a position comfortable in LIBOR variable interest rate. So, he wanted to convert the floating to fixed interest rate. The diagram is here as we discussed earlier problem. Company A is fixed of what 9%, company B is floating LIBOR plus 3.5. So, company A notional principal here, notional principal is rupees 10 lakhs. Now, what is the transaction process? Company B will borrow from the market LIBOR plus 3.5, the interest will transfer to company A. Company A will borrow at 9%, the interest amount transferred to company B. Now, company B is 9% paying, company A is paying 3.5%, LIBOR plus 3.5. Now, company A is become floating, company A is floating. Now, conversion is floating will be LIBOR plus 3.5, company B is now fixed, the fixed amount is 9%. The stream of interest will flow now. What is the stream of interest rate is here? The company now after 1 year, suppose after 1 year, the here transaction take place every year. So, after 1 year, suppose after 1 year, after 1 year is January 1st 2013, January 2013. Now, what will happen to it? The transaction take place interest rate. The company A will pay floating plus LIBOR. Suppose after 1 year LIBOR become 6.5. Now, LIBOR plus 3.5 become 10% now. Now, company A will pay floating. So, company A will pay floating means company A, the transaction for company A will be 10 lakhs into LIBOR plus 3.5, that is LIBOR is 6.5, 3.5, now 10%, that is company A will pay 10 lakhs into 10%. What will company B? Company B is now fixed because he transfer the interest, fixed interest, floating interest burden to company A. So, company B is now fixed. So, what is the fixed amount? 10 lakhs into 9%. So, now 10 lakh into 9%. Now, here if you see the interest rate differential is something around 10% of 10 lakh something 10,000, 10% 10 lakh something like 1 lakh rupees. Here also 9% is 9 lakh 90,000, 10,000 extra rupees will be transfer. Net transfer will take place, net transaction will be net transfer take place. Who will getting the benefit? Now, getting the benefit by the company B. Company B has transferred that 10% interest to company A now. Company B is paying how much? 9% now. So, there will be transfer of extra 1% of 10 lakhs extra 1% of 10 lakh to by company A to company B. After suppose after 1 year, next 2014, the 2014 comes, 2014 in 2014 January 1st 2014, what will happen? Suppose January 1st 2014. Now LIBOR become 5.5%. LIBOR become 5.5%. So interest rate will be 5% plus 4%, that is 9.5%. Again company B is getting the benefit. But when LIBOR become 4%, around less than 5%, then only, then suppose 4.5%, then plus 4%, that is 8.5%, then only profitability will be there for company A. So, here the fixed and floating interest rate beneficial is there for both party, but depends upon the fluctuation of LIBOR who is getting the most benefit. Thank you.